Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
What's happening with the U.S. car market?
Well, to take one step back from that, Trump made a speech last night that people were a little bit worried about going in. Was he going to act crazy in front of Congress? But instead, he made a fairly presidential speech, and that calmed the markets down. So U.S. stocks are way up this morning because that removed a big piece of uncertainty. But under the surface of this blow-off top in overall equity prices, you've got some stuff that looks an awful lot like bubbles bursting. And one of them is the auto market in the U.S., where car sales have been hitting records for year after year after year for the last 3 or 4 years. And we're now at all-time highs in the amount of cars, the number of cars that are sold each year. But that trend looks like it's rolling over. What happened was we car dealers offered extremely favorable lease terms, first of all, which caused a lot of people to lease rather than buy. And so those 2 and 3 year leases have come due, and now a huge amount of still in pretty good shape cars are coming onto the market, which compete with new cars, because a lot of people are smart enough to understand that when you drive a car off the showroom floor, it drops in value by 20 or 30 or 40%. So if you buy a fairly new but still used car, you still get basically the same car but at a much lower price. So those lease deals that are coming onto the market are presumably lowering the sales of new cars. And what you're seeing is car dealers having to rent extra space to park all their excess inventory. Now, what flows from that is, of course, big price cuts to clear that inventory, which may do what it's designed to, but because those lower prices are a lot less profitable for everybody concerned on the sales side, you'll see the auto industry start to scale back, lay people off, produce fewer cars, et cetera, to try to bring things back into balance. So that's a part of the economy that is likely to slow down in the next couple of years, and it's a fairly big part, with a lot of people making decent money building cars. So that could be potentially significant, although in and of itself it won't derail the current expansion. But taken together with some other stuff, it's possible that it might play a role. Another mini bubble that looks like it's bursting is fine art. Basically, the U.S. and most of the other big central banks of the world have been creating so much fiat currency over the last few years that rich people, who are the first beneficiaries of all that new currency creation, have more money than they know what to do with. And they've been spending inordinate amounts of it buying brand name art. And, especially from China and Russia, people like that who are new millionaires who are terrified by what's happening within their countries and want to get money out of the country. One really clean, simple way to do that is to buy a $50 million painting. It doesn't take up much space, and it's, at least the art dealers will tell you, that it's going to hold its value over time because it's rare. They will make no new Van Goghs going forward. That's a guarantee. And so it's something like, gold or silver. Things that can't be created by governments, therefore, will tend to go up versus the currency that governments can create and are creating. But it looks like art prices have gotten ahead of themselves, which isn't a surprise. They've just skyrocketed lately. And now you're starting to see some of them roll over. There's a story circulating right now about a Gauguin bought by a Russian billionaire for $85 million in 2008 is now worth 74% less. And art sales in general from the big auction houses, that's down dramatically lately, which implies that even the billionaires of the world are kind of tapped out right now. So that's another thing that implies that under the surface things aren't as great as you would think from looking at the stock market. And there are historical precedents for this. In 1999, the finances of the developed world were starting to get very stretched, yet the stock market continued to boom for a little while longer before it just crashed, and then the whole system went into recession. In 2006, the stock market continued to go up well into 2007, even though the housing market, which was one of the engines of the recovery up to that point, was already starting to roll over. And when the housing bubble really burst, it sent the stock market into a tailspin. U.S. stocks went down by 40, 50, 60%, depending on the index that you look at. So we're seeing signs now that are very similar to what we saw back then. In other words, a booming stock market. At the same time, a lot of trouble spots are bubbling up in the economy that don't get any press in the glow of new records in the stock market week after week and day after day. But they will become important factors when the economy itself starts to slow down. So I think 2017 could be a year in which what is perceived to be an overheating economy and booming stock market right now lead to higher interest rates one way or another, either via central banks raising short-term rates or the bond markets raising long-term rates. This sucks a lot of the oxygen out of what is really an overheated stock market at historically crazy valuations. You know, equity prices in relation to almost any indicator of corporate earnings or individuals' ability to buy stocks in the U.S. are at levels that historically have preceded big market crashes. So we're in one of those times now, Jim, and there's no way to know whether this is 2004 or 2005 or 2006 or 2007. In other words, whether the crash is imminent or whether it's going to go on for a little while before it happens. But I think it's very safe to say that something big and disruptive is coming to the financial markets based on valuation and the stuff going on under the surface.
We'll have more with John Rubino right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. John, is this a factor? I know millennials are not into cars the way that we were when we were young adults. And in Vancouver, I think we lead North America in car share services. Is that having an impact on auto sales?
Well, two things with millennials. One is they don't make anything like the disposable income that we did back in the day, because a lot of the really good jobs in which you actually make something have gone overseas. So they can't afford cars or houses on the scale that a 26-year-old baby boomer probably could way back when. So no matter what, they're not going to be buying cars on the scale that previous generations have. But as you said, car sharing services, you know, the world of Uber is a very different place for a young person these days from anything that you and I experienced when growing up, because especially if you live in a city, you really don't need a car even to get out of the city. You just call Uber or some other ride-sharing service, and they'll take you where you need to go via an app on your cell phone. So owning a car, having to park it, having to maintain it, having to pay insurance on it, you don't have to do any of that, really, unless you're somebody that commutes from the suburbs a long way to a job. Then you need a car. But if you're someone who doesn't do that, if you work at home or you live in a city and your work is not too far away, you really don't need a car. And then one stage beyond that is the world of self-driving cars, in which you have this fleet of, Uber-type cars, but that are robotic, that are driving around 24 hours a day, picking people up and taking them where they need to go, and in that way are incredibly efficient because that car never sits in a garage, as most cars do. Most cars sit for 90% of the day in a garage. Well, a self-driving car that is hooked into an Uber-like network just runs 24 hours a day, except when it needs to refuel and to be maintained otherwise. So the total number of cars that kind of a society needs is something like a third or a half of what this society needs. So that's terrifying for car makers on a lot of different levels, because first of all, fewer cars, you're going to sell less product. And second of all, the kind of car that kind of a system demands is very different from what this system demands. In other words, you want something that's comfortable and very safe, and it doesn't have to be flashy because it's not your car. If Uber picks you up in a minivan, that's fine. You don't care, even if you're somebody who's very status conscious, because it's not your car. It's just a service that you're taking. So the cars of the future are going to be economical and safe rather than flashy and fun to drive, which means, BMW and Lexus have some challenges ahead of them. And maybe the Japanese makers, to the extent that they tend to make more economical, more practical cars, are in better shape going forward. And the U.S. car makers, where they've bet their future on giant 7,000-pound pieces of metal that you drive around, and in other words, big pickup trucks and SUVs. It's not clear what the market for them will be going forward, but I think it won't be nearly as robust as it is today. So, an interesting world. Very different, very challenging for car makers, but that's the nature of technological society, is that every entrenched industry is facing some kind of a technological challenge, whether it's artificial intelligence taking over for accountants and tax preparers and money managers, et cetera, and lawyers, and doctors, where everybody's being challenged by the fact that machines can think now, and they can do some things that used to be considered creative, that humans get paid a lot for, and in the future they won't get paid a lot for. So this is an incredibly challenging world on a lot of different levels, but the auto industry, I think, faces maybe the most obvious and understandable challenge of any major industry, and I don't think they're really prepared for it. The auto industry has historically been blindsided by turning points, at least the U.S. auto industry. Some other branches of the global auto industry have been beneficiaries of big turning points, but our guys have never really shown a propensity for looking that far ahead. So we'll see. I think that could be a story going forward, where the auto industry gets lumped in with, for instance, bricks and mortar retailers as a sector that's under pressure that is not going to let up. In the same way that Amazon is just destroying Macy's and JCPenney and Sears, Uber and self-driving cars in combination will create the same kind of challenge for the auto industry. So I would say at some point, the big car makers are a phenomenal short candidate. And the question is when. They're up pretty well right now. So it could be that today is the day we're going to look back on the auto industry and think, wow, man, if I had just mortgaged the house and shorted GM and Ford, I'd have 5 houses now. We'll see.
We'll have more with John Rubino right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with John Rubino. John, going back to the Trump speech and its impact on the stock markets, at least it seemed to be more of a legitimate effort than some tweet in the middle of the night that would affect stocks like Boeing.
Yeah, I haven't listened to the speech on YouTube or anywhere yet, but I've seen some transcripts, I've seen some quotes, and I've seen some analysis that all kind of implied that he decided to settle down and try to be presidential, and that he actually has the ability to do it when he wants to, and that's really reassuring for the markets because President Trump was this huge wild card. And now, if he's going to try to settle in and be somebody that's somewhat predictable because he adheres to the behavioral norms of past presidents, then that removes a big source of uncertainty. But again, the really big source of uncertainty for the stock market, at least in the U.S., is valuation. And there's really nothing that can be done about that. You can fiddle around with corporate tax rates and stuff like that, but in the end, if history is any kind of a guide, then stocks are grossly overvalued, and they've got to go back down to more reasonable valuation levels. And when that happens, the stock market in the U.S. has to lose 30 or 40% of its value. The only thing that would keep that from happening is hyperinflation, or at least accelerating inflation, because that changes the measuring stick, the unit of measurement for the stock market. In other words, if the dollar goes down in value, then a company whose value has not changed will be worth more dollars, right? Because we're measuring it with something that is losing value. And so if inflation starts to accelerate, you could see the stock market go up in nominal terms. In other words, the level of the Dow will go up and up and up. But the real value, the inflation-adjusted value of U.S. stocks will go down. And you see that in, for instance, Latin American countries where Venezuela descends into absolute chaos, but their stock market goes up. And the reason for that is that their local currency is plunging at an accelerating rate, which makes the measurement of stock prices seem like the stock market is going up when it's really falling in real terms, but it's going up in nominal terms. That could happen in the developed world very easily if we let the current spike in inflation run for a while. Now, a lot of people think we should do that, especially on the left. The Keynesian economists that used to have a lot of sway, and who knows what they've got now, but they probably still do have quite a bit of pull out there in academia and possibly still in government. Who knows? They say that the way to get out from under all this debt is to raise our inflation targets to 3 or 4%. In other words, have a period in which we've got accelerating and fairly fast inflation going. Now, Trump is kind of sort of saying the same thing when he says we need a weaker dollar to boost the economy, because a falling currency value is inflation. It's just saying the same thing using different terms. So if it becomes U.S. government policy to accelerate inflation, then that would be good for stock prices, but it'd be bad for the whole world in every single other way. So I think it would be a catastrophe if we tried something like that, because it's been tried so many times in the past, and it's never succeeded. There's never an example in financial history where accelerating inflation led to good things in the decade that followed the acceleration. It always leads to some kind of a disruption. And Jim, I don't think we have time to go into why that is true, But let me just say that if you put yourself in position of, for instance, a stock speculator or a guy running a company or something like that, and you realize that it's the government policy to make dollars worth less and less every year, what's your logical response to that? It's to borrow more money, right? Because you're going to be paying that money back off in cheaper dollars. So accelerating inflation actually does the opposite of getting you out from under debts. It leads people to borrow even more. So at the end of the process, you end up with even more debt and an even bigger crisis looming out there. And that's what we're doing right now. As inflation starts to spike, it leads people to the conclusion that debt, taking on debt at current prices, current interest rates, is a really good deal. And that's why corporate debt has been soaring in the last couple of years. Corporations have borrowed record amounts of money in 2015 and 2016, and they've done that because they expect their sales to go up at the rate of inflation, which will allow them to pay off money that they've borrowed at below the future expected rate of inflation very easily and actually improve their finances going forward. So what we're seeing is a spike in debt across the global economy, partially in response to the idea that we might have higher inflation going forward. And so that's just going to lead to an even bigger crisis. So the good stuff you see happening now is going to be mirrored by horrible stuff in 2018, maybe the second half of 2017 and beyond. So none of this is good. Nothing that we see out there is good because it's all predicated on dramatic increases in debt, and that always comes back to bite the borrowers.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.